So coming up this morning, we have a huge treat for us. We have Spencer Rascoff, who's the former CEO and founder of Zillow, the current chairman and founder of dot.LA, Picasso, a storied angel investor here in LA. And he's going to be speaking with Bill Gurley, the general partner at Benchmark. It's going to be a fantastic session. So without further ado, let's take it away, Spencer.
Thanks, Kelly. Hi, everybody, and hi, Bill. Great to have you with us today. Thanks so much for joining. How you doing? Can you get the audio up a little higher for Bill? Or oh, it looks like you might be muted, Bill. There we go.
I was muted. There we go.
There we go. Life in a Zoom world that we all live in now.
Yeah.
Great to see you. Great to have you here. So Bill, you've had this extraordinary career as a venture investor. You still have an extraordinary career here. I was so lucky to have you as the first institutional investor at Zillow and in my boardroom for, I think, 10 or so years. You've been involved in Uber, Snapchat, Twitter, your firm in all these incredible companies, OpenTable, you name it. Being a great early stage investor is all about pattern recognition. And I've seen this personally as I've been doing more angel investing myself. So give some insight into what you look for at an early stage pitch, either in the founder or the business idea. What, having looked through thousands of pitches over your career, yeah, give us the pattern recognition insights.
There's a couple of things I'd mention. The first thing I mentioned, I think people will find remarkably unhelpful, which is there's a phrase that came way before me called unfair competitive advantage. But if pure competition that you would study in business school is the worst case scenario, how do you have a company that's not in that place where it's not a commodity, where it's differentiated? Those things that you look for that are like that typically lead to unfair business models. So high margins, defensibility, high growth, that kind of thing. And having spent most of my career in the consumer internet, there's an overused term, network effects, that I think you're looking for a lot as the thing that would build in those unfair competitive advantages. So that would be the first one. I'd say the second thing that doesn't get talked about enough is go to market. And I think both on the consumer and the enterprise side, for Zillow, I think it was the Zestimate, like how you're going to launch yourself into the world in an unfair way. Use that word unfair again, relative to everyone else. I think Facebook's approach of going slow through Harvard, then the Ivy League, then college, built something much more durable than MySpace did, who just kind of launched everywhere.
Well, actually, I want to drill down on that, because you once, you were you were an early investor in Yelp. Were you on the board of Yelp as well?
Peter Fenton.
Peter was. Okay. So, yeah. But you frequently cite Yelp as an example of where they started small, and I use that when I talk to marketplace founders. Can you describe what you mean by that?
Yeah, they started small and slow. So there were two competitors to Yelp right when Yelp came up, both venture-backed with lots of money. One was called Insider Pages, and another one out of Seattle was called Judy's Book. And they both ran out, and you could buy like small business listings from ABI Info or something, and they both just put every company in the country on a website and said, come review it. And Jeremy Stoppelman was started with nightclubs in San Francisco. So he sliced off the tiniest of tiny pieces of the market. But he spent a lot of time making sure, I've made up this phrase, liquidity quality, making sure the liquidity quality was high. So super high signal, super high engagement. And he was out at the nightclubs and giving out T-shirts, and people cared what their rating was for rating these things because he was so focused on the engagement level. And from there, it bled into restaurants and eventually from San Francisco to LA. And there was so much more signal. There was so much more livelihood in what he had versus everyone else. And the Judy's Book founder wrote a interesting blog post about this, because it's good to get both sides of the story.
Well, so the phrase that I think you took out of that was, it's okay sometimes to do unscalable things. And I find that I get a lot of marketplace pitches, and I invest in a lot of marketplace businesses. And, in a marketplace, in a two-sided marketplace, You have, for example, in Zillow's case, you've got consumers and real estate agents. In Uber's case, you've got drivers and riders. In Yelp's case, you've got users and restaurants. There's an LA startup that I'm an investor in that I know dot.LA has covered called AirVet, which is telemedicine for dogs, for veterinarians, right? And you've been in related spaces here. So you've got pet owners and veterinarians. Yeah. And so a question I usually get from marketplace founders is, which should I focus on first? And I have a point of view, but I'd love to hear you talk about how you think about jumpstarting those marketplace businesses on two-sided marketplaces.
Yeah, there's some people get upset about this, and there are certain exceptions where you have very special non-rival supply. But in general, I think the rule of thumb is supply is pretty easy to get. If you call up a business owner and say, "Hey, I'm going to send you free leads," they go, "Okay, I'll sign up." Like, it's not that tricky. Like aggregating demand is always the tricky part. And you do have to do it in balance and all these things. The exception I meant was like if you are trying to build a marketplace for tickets and you have to have the Lakers, like there are weird examples where supply is everything. But for the vast majority,
typically prioritize the non-pairs. So, focus on the consumers and then the real estate agents will follow, focus on the riders and then the drivers will follow if you're Uber.
And the key reason for that is you're bringing economics to them. I mean, I'm a big, wealth of nations kind of believer in capital markets, and if you get the money flowing in a particular direction, you have immense amount of power.
Right.
One quick thing, because we were talking about geography before that. I meet all kind of founders that are doing these local marketplaces that want to know, like, how many cities do I need to be in before I could raise a Series A or a B? And I'm like, you got it all wrong. Like, if you're dominating, Des Moines, and that's replicable, like whatever playbook you use there, that's 10 times more exciting to me than if you're in 5 cities and only a little bit of light in each one.
The startup that I just launched as co-founder and chairman is called Picasso, which is creating a marketplace for vacation homes, for second homes. So you can buy a fraction of a vacation home. And we had this debate internally. Do we launch nationwide? Do we just launch in some markets? And it was, your advice was ringing in my ear around focusing small. And there was definitely an argument of, hey, let's just get this right in Santa Barbara or Napa Valley or Park City, and then we'll take it nationwide. In Picasso's case, we decided to go national initially because we thought it would be a big consumer PR launch, because the team that we had assembled and the amount of money that we had raised, we knew we'd get a lot of PR. So what we did though is we kind of hacked a local approach where we launched nationally, but really we're focused on these 10 markets kind of operationally. But it's hard to, I don't know. We'll see. I wonder if that was the wrong decision. We'll see. I love your advice, and I still take it to heart even with my own startups. One of the things that we talked about yesterday in the pitch competition is that during these periods of huge change, which COVID obviously has driven huge societal change, new winners emerge. And we've seen this in category after category. Zillow was a clear beneficiary of the 2008 financial crisis when real estate collapsed. And Zillow helped kind of come out of the ashes of that. So in terms of investing themes that you and Benchmark are looking at coming out of COVID, what are some big macro changes that you think we're going to have as a society, which will sustain post-COVID? And how is that impacting your investing?
Yeah, the most obvious one, is everyone's talking about is work from home, and that includes everything that is Zoom that we have here, and whether or not, companies are going to be more distributed, more virtual. Our mutual friend, Rich Barton, has a very strong form view of this. Reed Hastings is on the other side. I'd say the answer is probably somewhere in the middle. We have funded startups since COVID that have no office, more and more of them. I've also worked with startups who are, Series B kind of stage, where they were struggling to find like a mobile developer of certain kind, like an Android. And because they're virtual for the first time, they said, well, why don't we just, recruit everywhere for that instead of here? And they filled it a lot faster. And so, you start feeling a rhythm that you weren't doing before. Salesforce productivity in our enterprise companies is way up, and you have to wonder what that means for T&E expenditures, business travel, those kind of things, and how that's going to be impacted. I'm a big believer that this comfort that we now have with online video is going to speed up a whole bunch of stuff. Telemedicine has already accelerated as a result of this, but I think, one-on-one instruction, one-on-one connectivity, being able to use your expertise to make money from all over the world, and just a general ease of being able to match expertise with need in across a global scale. I think that's going to accelerate all kind of crazy stuff. I'm curious about startups like Patreon and even Cameo, in that they allow a human to just sit there in their house and make money. And I wonder, I've always wondered why Twitter hadn't done that, LinkedIn hadn't done that yet. It just seems like, it's going to happen. So I think you're going to see some really interesting things come out of that.
It's funny, actually, the origin of Picasso actually was in Austin, and I discussing that idea around, this is pre-COVID rather, a talent marketplace for information. Sort of, I've got this asset in my mind, I'm an expert on all this stuff, and you might need information on that. How can we match supply and demand? And we shifted to real estate, which was, well, there's another underutilized asset, which is a second home, which sits empty most of the year. But it was exactly that we were just one hop away from knowledge to real estate. But the marketplaces that are now starting to splinter, this kind of talent marketplace, you've talked about this a little bit, and it seems to be a hot investing theme among VCs. Can you just discuss that for a moment? We're starting to see the emergence of kind of these vertical talent marketplaces in certain categories. Why is that?
There was this famous, many of you may have seen, there was this famous blog post someone did about how Craigslist was being picked off by people that were doing each of those things better, Zillow being one of them, but there were, jobs and dating and all these things that used to live on Craigslist. And you just bring, way more understanding of the vertical through taxonomy and ratings and ease of use. The same thing started happening to eBay. The company that Etsy bought called Reverb. If anyone's into music or musical instruments or amps, or go on Reverb's site. It's unbelievably well done.
Or look at Goat. I mean, right? Goat's one of the big LA startups, and just raised another big round, and their vertical marketplace in sneakers, which is one of eBay's categories.
Yeah, totally. And so, and so this is now, people are thinking about this relative to LinkedIn, and can you go out and do something? I've spent a ton of time in the area. We've got several investments, including we're in Medley in LA, in the nurse space. And it's, I think we're still learning the rules of the road. I have some knowledge that I might consider pseudo proprietary about what works and what doesn't. But, I'll talk about a company we're not in that I wish we were in, is RigUp. So Founders Fund backed a company out of Austin, Texas called RigUp that does this vertical marketplace labor for oil field services. And they've had to obviously deal with what's happened with the shocks in oil prices recently and that kind of thing. But really great founder. I've gotten to meet him and spend some time with him. And what's great about that category is the work product is something that is temporary. So you come together for a month or 60 days or 90 days, you redo a well or you add fracking or whatever, and then you go away. And that come together and tear apart piece, I think, leaves a lot of opportunity for a vertical marketplace that can understand the individual skill sets and reputation of the people, who's available. The matching, has so much more power. And so I think that's a little bit of an important piece around these labor marketplaces, that if you're just sending people in to be permanent hires, they're not going to come back for 5 years, right? And so you have less fluidity through the marketplace.
So that reminds me of a question that I get a lot from founders, which, let's say you're the CEO of RigUp, and you've just raised a Series A, and you've got traction, and you're launching, and your things are working, and you get that call from someone in LinkedIn biz dev, or kind of one of the big boys, or let's say your GOAT and eBay calls, and how should a startup that is trying to disrupt a bigger company, how should they think about interacting with that bigger company, and at what stage? Like, do you take that call at the seed stage when you just got launched, or do you just say, hey, now's not a good time?
I'm going to come back to that real quick. I just thought, since you were asking about these vertical labor marketplaces,
Yep.
We did just announce yet another LA investment. We've made over 20 in the history of my firm in this company called Impact, which is a partnership that Benchmark has done with the guys at Imagine, Brian Grazer and Ron Howard. And it aims to do this in Hollywood. And so it's early. Netflix is an early customer, which we're super excited about. But that's one where you have this temporary work product happening, which is why we were so excited about it. Okay, on to your question.
well, that's okay. I want to hear more about Empath before we move on. So just describe the business in a little more detail.
So I was on the phone. Well, I had made this decision after we had missed Rig Up to look for other categories where this dynamic happens, where you have temporary work product. And the one that is obviously pops through your head is movie, film, TV production, because they're constantly coming together and tearing apart. And I called a good friend of our firm that we've known for a long time, Michael Litton, who used to be head of Sony Pictures and is chairman of Snap, and said to him, what do you think about this concept? And he said, you should talk to Brian and Ron. And he was on the board of Imagine at the time. They had created something mirrored after YC, which was a competition to discover writers. And we spent a ton of time together talking about how that could be morphed into a talent marketplace. And so right now, at its current stage, Impact is a marketplace where writers can come together. During COVID, it's production's on halt, so writing is actually a good place to be. And if anyone like Netflix, who's one of the first big customers, is looking for writers in a particular category, they come in and they say, "We're looking for a Spanish rom-com," and the writers pile in, submit ideas, and bubble up. And I think there's like 23 projects that are now launched from writer matches within the system. And obviously we have a lot more that we want to do on that front. But if, one of the things that you have in LA is you have a lot of people that are passionate about the Hollywood industry, but also might have tech skills. So CEO's name's Tyler Mitchell, or reach out to me if you want to work at this company. It should be an exciting ride.
Awesome. All right. So yeah. So how do you handle the big guys, the big scary tech companies if you're a little startup?
Well, the trick, I think everyone's taught that the right answer is, I'm never selling. I'm going to be independent forever. So I can't talk to you. And there's this kind of, you got to be brave and strong. I don't think that's realistic. I think that if you're ever going to be acquired as a company, you have to establish relationships with the people that might acquire you. It doesn't mean you have to give them your secret sauce. It doesn't mean you have to do the one-sided business deal that they want you to do that you don't have to do. But I think you'd be crazy not to pick up the phone. You might learn something that's helpful to your business. And, there's this famous story of Zuckerberg and Evan Spiegel walking on the beach, talking about acquisition. And Evan said no, and LA is going to be way better because Evan said no. But he took the meeting, right? Like he listened. And so I think you have to, as you get bigger and bigger, if someone wants to chat, I think you have to chat. I think you should be remarkably comfortable saying no.
So let's talk about managing through adversity and managing through a downturn, because you've been, obviously the thing about being a great venture capitalist. Oh yeah.
One quick thing on that, Spencer. So, we love to celebrate the success stories, but the vast majority of startups, aren't Snap. And once you are a founder and you've hired 100 people and you have a responsibility to them, you may reach a place where selling the company is the right answer for all the constituencies involved. And if the first call you're making to a potential buyer is, hey, will you buy me? That's going to have a remarkably low probability of success.
Right.
And I've watched that happen over and over and over again.
Yeah,
and
no, I agree with this advice, and I've shared it with plenty of founders, and I've seen it from the other side at Zillow, where we bought 16 companies when I was CEO, and every one of those was a multi-year dance where we got to know the smaller company over time, and maybe there was a biz dev partnership, or maybe they spoke at one of our conferences, and it took time to get to know each other. The scary thing from now that I'm on the other side, the startup side, is, you want to whet the appetite of the big company and let them know that what you're onto is exciting. But if you get their eyes too wide at what you're doing, then might they try to do it themselves? And so that's the tricky thing on being on the other side, on the startup side. Managing through adversity is a great. It's hard, right? And I have been around long enough to have seen 3 giant crises: the 2001, the recession, and 9/11, and internet bubble bursting, which all kind of came together over a 2-year period. The 2008 financial crisis, and then now COVID. And you've of course been through those 3 and more. So I'm interested, from your experience of being involved in so many companies, how does this current operating environment, in what ways is it similar or different to other challenging operating environments? And what general advice are you giving to your CEOs and your boards about operating through COVID?
Yeah, there's one thing that's remarkably different from 99 or 01 and 09, which is when COVID hit in February and March, everyone got nervous like we did back then. And everyone with pattern recognition got really nervous. Some people didn't live through those other things. In both of those other cases, capital got scarce. And, it just basically, you weren't going to raise money for 12 to 18 months. Just nobody was. And that did not happen this time. And people that talk about it say, well, it's because of the Fed flooded. A lot of times when capital becomes scarce, it's because there's a run on the bank. And I remember in 09 being on the phone with, Morgan Stanley saying, how does this custodial thing work? Because you might go bankrupt, and that just didn't happen this time. And so without the run on the bank, there was plenty of money around. When stocks got hit heavy in March, a lot of people dove in and bought. And, people were talking about V or U or J recovery. It just went straight back up. There was only 2 weeks of buying opportunity. Yep. And so all that's radically different. There's one thing that I found that you probably won't hear anyone talk about, but in some of the industries that got hit hard, right, there was, 15% of companies were in travel or a category that just unfortunately serve restaurants where they had, they got hit hard. There was some right sizing done in some of these companies, and some pivots or just light pivots, not full pivots, to try and orient. And then when things started coming back, some of these companies got to break even way earlier than they would have before. And there's going to be
Airbnb, people thought Airbnb was sort of on, down for the count, but they right-sized, they saved a lot, cut a lot of costs, and now they're on their IPO track again. Right?
There's 3 or 4 in our portfolio like this, where it's like, they prior to COVID, they thought break even was 100 million in revenues, and now it's 60 or something. It's like, so they're going to be these Superman, rising from the ashes kind of things that are going to happen as a result. And it's always a great reminder. I think companies get addicted to growing headcount. And even the head of marketing, the head of engineering, they get accustomed. You've operated more than I have, but get accustomed to saying, "Oh, I need 10% more," and they never settle down out of that. And so anyway, that's interesting.
It's true. And this happened with Zillow in 2008. We did layoffs. We went from 200 employees to maybe 125 employees. And at the time it was like, oh my God, how can we possibly get everything we need to get done? with so much less headcount. And that somehow it all worked out. Somehow we became a lot more efficient, a lot more effective. Meetings became shorter and smaller. There were fewer decision makers. Things happened more quickly. We had to prioritize more effectively because we did have fewer people available to do things. And suddenly we became a lot more profitable. So sometimes these shocks are really valuable resets for companies to right-size their headcount. And that is the perfect segue into the other thing that you've been such a vocal person on, which is marketing spend, right? I mean, you had many contributions in the Zillow boardroom, but one of the most notable was how you articulated the argument against advertising. And famously, Zillow didn't advertise at all for the first, I don't know, probably 5 years or so. And you always said, look, anything that you're going to go give to Google or Facebook or any type of online or offline advertising, let's invest that in the product. Let's hire an engineer, let's hire a designer, let's hire a PM and build cool stuff that people want to tell their friends about. And that was very valuable advice. Do you still feel that way 15 years later in the startups that you're in? What is your take on advertising, offline or online?
I mean, I do. I've written lots and lots of blog posts over the years, but my single favorite is on this topic. It's called The Dangerous Seduction of the LTV Formula. And please go read it. But once you have a large scale purchasing, ad purchasing part of your organization, the creativity around viral growth goes to near zero. And the problem is that buying ads to generate demand on your network is the most brain dead, simple thing you can possibly do. Like, think about it. An entrepreneur that is out of the worst school in the country, that is in the worst city to build a startup, that's the path they would choose, right? I mean, just think about it. Everyone knows you can buy Google ads. It's the least interesting. If you can come up with something like the Zestimate or some type of viral loop that bounces two sides of a marketplace off of one another, it's just so much better. I'd even rather give the money to the customer than Google. Like, I'd rather have negative unit economics to spin up a marketplace than I would paying somebody else.
And so that was Uber's philosophy, pretty much, right? They're like, let's subsidize rides rather than do paid acquisition. And that's how they grew on the two-sided marketplace. They grew riders first, then drivers. And actually they subsidized the driver side of the marketplace too. They gave the unit economics to the marketplace instead of to an ad channel. And it clearly worked. They got escape velocity, and then, and now they'll be able to become more profitable over time.
We hope.
We think. Well, they're valuable,
That's true.
and likely profitable, and likely someday profitable. All right. So the someday profitable question takes us to the IPO conversation. And, one of the other, I feel like in the last 2 or 3 years, you've been on this personal campaign, personal jihad to move the venture community, the startup community, the founder community from the stay private longer mentality to there are benefits to going public. And OpenTable was one of your first ones. I mean, I remember when we took Zillow public in 2011, you were pointing to OpenTable, which you had encouraged to go public a couple of years earlier, I think 1 or 2 years earlier. And we were both small IPOs. Zillow went public with a $500 million market cap. Think about that for a second. Think about how many unicorns there are that are private and multi-billion value. And yet Zillow went public with a $500 million market cap. So we went public very early, just like OpenTable.
So did Amazon, by the way.
So did Amazon, so did Microsoft. And even so did Google, actually. So the pendulum shifted somewhere, in the 80s and 90s, the pendulum was go public early. And then in the 2000s, it was stay private longer. So, I share your perspective on this, and I'm sort of Exhibit A, or I guess Exhibit B.
I read what you wrote.
Exhibit A. But explain to our listeners why you think it's beneficial to go public. And we'll come to the SPAC question later. Just generally, why be public versus stay private longer?
Other people like yourself, Rich Barton, Mark Benioff, have talked about this, and as operators, I think the weight that you guys have saying it is far better than me saying it. But I think the answer is it simply makes you better. And the example I like to use is comparing it to the NFL. And do you play, does anyone say, oh, I want to stay in college longer? Just like they don't. And I'd say imagine if there were a quarterback that right before the NFL draft that was picked to be in the top 10 draft picks, and they interview him and he says, I'm just not sure I want to play on Sundays, because they record everything and they write down every stat, and there's 60,000 people watching. And, I think I can develop my game better if I don't have so much attention or scrutiny. If someone did that, they would fall in the draft immediately. And when entrepreneurs take that attitude about the public markets, they should be aware that the buy side's listening, even when they're private. And the buy side doesn't want to own the stock of the CEO who's afraid to be a public CEO. And so you're in the game the minute you incorporated in Delaware and started handing out options to people. And it's an up or out game. And I'm sorry, and it may sound harsh, but it's an up or out game. And so, you have to decide whether you have what it takes to go the distance. And because of the capital availability, some people have been able to stay private longer, but you run a big risk that you're just not making your company better, that you're not getting the processes in the right place, that you're not making sure that you have an audit and that your rev rec's right, and all these different things. And I think the operators like you talk about this from the other side. So maybe you.
So I actually totally agree, and I had this conversation last night with the founder CEO of a private LA unicorn that is having this discussion right now. And here's exactly what I said to him. I said, being public makes you a better company. The simple act of once a quarter having to get all your ducks in a row and articulate to shareholders and prospective shareholders what your company's up to, how you've performed recently, what you're going to accomplish over the next quarter and several years, that makes the company better. Everybody up levels their game. Your VP finance gets better or they're out. Your head of engineering has to get better or they're out. It's big time. And yes, that it's stressful, and yes, being under the glare of the shining lights can cause stress. I think the NFL versus college is a perfect analogy. But that's life in the big city, and and it makes you and the company better and stronger for it. And in particular, if you can manage the vicissitudes of the stock market by having a board with a steady hand, having good shareholders that you've worked hard to curate and cultivate, and being really long-term oriented as a CEO and communicating that to your employees, then you can really mitigate the negatives of being public, of having a volatile stock price that is a daily barometer of the company's health and success. And then it's 95% goodness and only 5% challenge. And that's what I told him last night, and that's what I would tell anyone listening.
Yeah, and I would add two things to that. One, there's this myth in venture land that Wall Street's not very smart, and it's just wrong. And when you get out and talk to portfolio managers, you're going to find out that they're some of the smartest people in the world. And there's an interview that was done with Zuckerberg where he said he regretted staying private longer and he should have gone public 2 years earlier. And
I totally agree. And I think this point is really missed. Let me just describe how this bears out. This is in my calendar in a given week, I probably did 2 or 3 shareholder calls with hedge funds, mutual funds, or other big investors in a given week. And you're sitting down with some of the smartest people in the world who have made tens of millions or hundreds of millions of dollars in bets on the future of your company. They're spending, in a lot of cases, almost all day long surveying the landscape, talking to competitors, interviewing customers, comparing how this business, let's say it's Zillow in the US real estate business, is similar or different to other countries. And they're getting pattern recognition from what they're seeing elsewhere and looking at other companies. And they're giving you insights and asking you questions and telling you what they're learning. it's incredibly useful. It's very, very valuable. It's like having a supersized board of directors. Instead of 4 or 5 people who are in Silicon Valley every day, these are people that are out there buying and selling stocks of like yours and others, and coming with a different perspective. It's invaluable, actually. And people don't talk enough about the benefit of that.
Yeah, and then the other thing is the other reason that you typically hear people crap on being public is they say Wall Street will force you to be short-term oriented. And, I have two thoughts on that. One, if you understand discounted cash flows and how you value financial assets, it's impossible for it to be true because these companies trade at way too high multiples for next quarter's cash to actually impact the valuation. But if you're moving away from the theoretical, look at Bezos, Benioff, Hastings, now Elon. They've run these companies in a way where next quarter's earnings or cash flow just aren't really what the game is. And,
Yep.
If you look back, those haven't been easy rides. Amazon traded at one-time revenues for a long time. Netflix had massive cycles up and down. But they all did it their way, and they all did it with a very long-term orientation, and it worked out in every one of those cases. And you don't see any of those CEOs go on TV and whine about how horrible it is being public.
Right. So there's a new-ish way to go public. It's actually not that new, but it's newly in vogue, which is a SPAC. Full disclosure, I have a SPAC. My SPAC is called Supernova. It went public last week. We raised about $400 million, and it's publicly traded right now on the New York Stock Exchange. And what these SPACs do is they look for a private company to merge with. And when you merge that private company into your SPAC, that private company goes public by virtue of the merger. So, and typically when you hear about the size of a SPAC, you have to multiply by sort of 4 to 6x how much they hope to buy. So a $400 million SPAC is looking for a kind of $1 to $5 billion private company to merge with, to take public. So you've been a pretty vocal supporter of SPACs, and more importantly, you've been a very vocal opponent of the issues with the traditional listing process. Yep. So what is wrong with the traditional IPO process, and why should private companies consider alternatives to the traditional IPO, such as SPAC?
Yeah, first on the what's wrong with the traditional IPO process, I'm the latest person to carry the flag, but I'm not the original person that picked up the flag. Larry and Sergey had very outspoken views on this. Pierre Omidyar tried to get his board to do something different. Bill Hambrick was a big, proponent of what he called the auction. And NetSuite went public through one of those. So there were people before me. And then Barry McCarthy really deserves 90% of the credit around direct listings because of the work he went through, and Daniel Ek supporting him. And of course, now there's been 4 of these direct listings, but I'll make this super simple. When you go public through a traditional way, there is a agent that's working on behalf of you and the other person on the other side of the marketplace. And there's almost no marketplace where that's true. In this case, they do business with that other side all the
investment
time.
Bank. Yeah.
Investment banks and the buy side. They do business with the buy side all the time, and they rarely do it with you. And the system by which they've decided they're going to allocate this money of your company has gotten worse and worse and worse. And it'd take too long to go through here. But they basically pick a price by hand, and they pick who gets the shares by hand. And it turns out that the underpricing has gotten worse and worse and worse. So there was $6 billion in underpricing in 18, $7 billion in 19. There's been $24 billion in underpricing this year to date. $4.5 billion on Snowflake alone. And the direct listing simply does what any comp sci or first-year finance student would do. You let people bid, you allocate shares based on the price they bid, and you open it up to everyone. I did this with Palantir just to prove it. I went in Schwab and Robinhood and bought $10. I wanted to prove it could be done. I got allocated into the IPO. You can't do that with a traditional IPO. The vast majority of people aren't even allowed to bid. It's a shock that that the SEC allows it because it's such a game. Anyway, because you've had 24 billion of underpricing, you create massive financial arbitrage opportunity for people to find other ways. Direct listings one, and the SPAC process all of a sudden looks 10 times better than a 50% cost of capital, which is what you have with an IPO.
Right. So a traditional IPO, tech IPO, typically trades up 43%. So this in the first day, that's what the data says. So that underpricing is basically a gift that is taking money out of the pocket of the issuer and giving it to the buy side, the mutual funds,
and listen,
that are the real clients of the investment banks.
Everyone on the cap chart before the IPO paid for that. So
right. Employees, VCs.
Yep. Employees, founders, investors.
Right. So, I mean, we saw this at Zillow, right? The 12 to 14 was the initial price on the cover of the S1. Then we upped it to 16 to 18 and the book was like 30 times oversubscribed or whatever. And in that pricing meeting the night before, the banks want us to price at 18. I insisted that we price it at 20, which seemed kind of crazy. And it traded at 60. You were on the call and you were like, yeah, we should push it to 20. I agree with Spencer. Let's push it to 20. And the bankers were like, no, the buy side will be upset. And we're like, screw them, it'll be fine. And the first trade was 60 and it closed at 37. So we left a massive amount of money on the table and gave it to Fidelity, T. Rowe Price.
Absolutely. And listen, the process now, best practice is to target this 30x oversubscribed. It's the most absurd thing in the world. Where would you have to price your house to have 30 bids before you sold it? It's no supply and demand or how you set price. The fact that they acknowledge that their goal is 30x oversubscribed it's like brain dead. It's like financially ignorant. Anyway,
the direct listing, I'm on the board of Palantir. We went public through a direct listing a couple of weeks ago.
Yep.
That's an alternative path, which doesn't have the huge pop, which is much better. And SPACs are yet still a third path, which have other benefits, which we can get into some other time around being able to share projections and some other benefits of going public through a SPAC. But it's great to see some disruption finally coming into the space. I mean, the Google auction in 1999, I think, when was the IPO auction? Was it 1997? Whenever the Google IPO was.
03, I think, I'm guessing, though.
That way? Anyway, we thought that would kick off a wave of innovation in the IPO process. And yet this is one of the last markets that really hasn't been disrupted by innovation. And it's great to see some more direct listings now and SPACs offer an alternative to the traditional IPO. Okay, we're running out of time, so I want to quickly talk about big tech and antitrust. The big tech CEOs are in front of Capitol Hill again and being raked over the coals in Congress. And I want to get your opinion, but I want to try to separate out some of the different companies, because they're all kind of in hot water for slightly different things, right? So Apple is in hot water because of the 30% tax that they charge for in-app purchases in the App Store, and the App Store has so much market share. So just for a second, focusing on Apple, do you think there's any there? Is there an anti-competitive issue with respect to Apple's tax for App Store transactions?
I think the fact that I wrote about this many years ago when they picked that number, I think it's an aggressive number for any marketplace to take 30%, and it drives scrutiny. I think the fact that Google is pegged exactly at the same number is a bad fact, not a good fact.
Right. The Android App Store also happens to be at 30%. Yeah.
Yes. And they both Android made this decision to push their luck right now. And they tripled down on their commitment to charging it. And, that's a self-inflicted wound. And the other thing is there's a massive arbitrariness to who they charge and who they don't that is a result of taking such an aggressive number in the first place.
Okay, so Google is in trouble for a lot of things, but the one I want to ask you about is biasing their search results with Google's own properties. So putting Google Hotels in front of TripAdvisor, for example. And of course, Google has huge market share in search. So is there any there in your opinion? Does that give you anti-competitive concern?
Look at this. If their two largest advertisers, Booking and Expedia, they're now competing with you. If you bought into the deal that they seduced you with around Android being open source. If you were a carrier or you were a handset manufacturer, you were left with the belief that with this open source product, you'd have more control over the menus. You'd have more control over the apps that were preloaded. You would be able to have a unique, differentiated environment versus Apple. That didn't happen. They pulled up, they created this master license agreement. They literally tied your access to YouTube and their other Google Maps and other properties to you, and they took that away. And so the one thing that's very obvious to me about Google, you also feel this if you've ever been in a biz dev meeting with them, is they're very willing to use their power. And as I see it from the startups that I've been involved with, they offer you deals that if you did them, Wall Street, if Wall Street saw the contract, your stock would dive. So they're offering you partnerships that suck, like that really suck. And you're tempted to do them because of the market power. And so I think all those are signs of someone. So it's coming at it from a different way. It's signs that someone's able to pull off deals that are completely one-sided. And that's a sign of market power. One thing I would say about whether it's Google, Facebook, Amazon, any of these people, like they exist because the antitrust department stopped Microsoft from their constant march to tie one product to the other. And Microsoft was fantastic at it. And Slack's feeling that today with Teams. They're still good at it. But the Justice Department told them they had a fence around the browser and they were no longer able to march and tie through that. And that was great for many of the companies that are getting scrutinized today. Right. It's an important fact to remember.
So the other thing I think is interesting about the Microsoft situation is having hired lots of people from Microsoft and Expedia over the years. If you ask them what happened to Microsoft, why was there a lost decade? They'll say that it was because of the shadow that the DOJ investigation cast over the company. And it wasn't so much the ultimate verdict or decision or the settlement they reached, but it was how constrained they were operationally during that time, that they couldn't they couldn't operate freely. They couldn't send email about things. They couldn't have meetings about things. They couldn't launch products. Like it was it had chilling effect internally, and It created sort of a lost decade. And that's what I think will be interesting to watch at Google in particular right now, but potentially Facebook as well, of whether innovation is stifled and they act just less aggressively because of this investigation.
I mean, going way back, there's a book called Big Blues that studies IBM's fall and mentions the exact same thing.
Really? All right, last question, Bill. We at dot.LA are on a mission to shine a light on all the innovation that's happening in the LA tech community. You and Benchmark have been big supporters of LA, from Snap to Jamdat to countless other companies. So give us your perspective about the Los Angeles tech ecosystem. Why are you long LA?
Yeah, I mean, we've just found a number of great opportunities over the years. One that you didn't mention, Riot Games. Mitch was the chairman and was there from the very beginning, and it was the first entrepreneur that really embraced digital item sales in the gaming world. And we sold that too early. It's a massive company, and I'm so thrilled for the community that that Evan stayed on the ground independent and that he's really soaring again at Snap. That kind of thing, having a legacy company that's here for the long run is probably the best thing that could happen to LA. Hopefully Doug Hirsch and GoodRx can do that again. And those are the things that'll make it really soar. But great ecosystem, great founders. I think historically a little too transactional, which I blame on Hollywood. And so you tended to have more M&A outcomes than IPOs. But hopefully with Doug and Evan leading the way, you get people to think longer term about compounding, and you get some real landmark iconic companies that'll be around for a long time. And those things have really long-term impacts in terms of how they shed people that have wealth and can go be founders or go be angel investors. And so I think we've really passed through something in the past year or two that's super important for LA. And of course, the arrival of Spencer Rascoff and dot.LA, knowing how much GeekWire helped the Seattle community.
Yep. Well, that's what we're definitely trying to replicate here. Thanks so much, Bill, for the conversation. We really appreciate it. Be well. Thank you.
Bye.